Chapter 8. In this chapter, I'm introducing the measurements and the reporting issue related to the inventory, which is an important asset on the balance sheet. Also, the related expense is cost of goods sold, which is the first expenditure deducted from revenue in the income statements. The definition of inventory refers to the assets a company intends to sell in normal course of business. Also has in production for future sales or used currently in production for goods to be sold. The purpose company holding inventory is either for production or for sale. But production finally is also for sale. So the ultimate purpose of inventory is for sale. And cost of goods sold is the expense related to the inventory. Because when the company sells the inventory, the company should also recognize expenses. This is a process when assets become expense. Actually, most assets will finally become expenses. When inventory become expense, when the inventory are sold. So the typical journal entry for this is a company debit cost of goods sold. I use COGS to represent cost of goods sold and credit inventory. Debit and credit. And there is a accompanying journal entry is the company will recognize revenue from the sales. Or the company, if the sales is on credit, we will debit accounts receivable. So the realization of inventory is the sales revenue. We also recognize expenses. And the value of the expense is same as the value of the assets. When we study inventory, we should also differentiate the business or industry characteristics. In this textbook, we focus on two. One is merchandiser, the other is manufacturer. Manufacturer inventory is more complicated because the assets hold not just for sale, it is for production. So for the manufacturer, they usually report inventory into three different layers: raw material, work in process, and finished goods. And three layers of inventory also represents the degree of completion. Raw material represents the production procedure has not started. Work in process, it starts but not finished. Finished good, that means production procedure are complete. For merchandising inventory, the valuation is simple. So the goods basically or inventory are purchased for resale. And the cost of inventory is the purchase price plus the cost necessary to get goods in condition and location for resale. It usually includes the logistic costs. In this slides, I'm introducing what's the difference between these three layers of inventory for manufacturers. So raw material is very simple. It represents the cost of components purchased directly from the supplier. They will become part of the finished products. But at this stage, this raw material has not entered in the production procedures. Work in process represents the inventory. They are in the production procedures, but not complete yet. The cost of work in process includes three components. While finished goods, they exit from work in process because the manufacturing procedures has been complete. If I use this flow chart to show you, here this is raw material. The production procedure is 0%. It has not started yet. While the finished goods, they're finished because the production procedure has 100% complete. There are these two work in process. Work in process is not raw material because it is in production, while it is not finished goods because all the production procedures have not 100% complete yet. So company also report, especially for the manufacturers, they report their inventory in 3 different accounts or layers. And this is financial data from Intel Corporation. So this provides more useful information for investors to investigate the change in each layers of inventory for their financial analysis. And here we can see the raw material increase a little bit comparing with prior year, while work in process there's a significant increase. Finished goods reduced by $350 million. There's reduction. The total inventory actually increased. The interpretation of this change in inventory also depends on other informations. So this actually provide the investors more useful information. And this slide shows the inventory components and the cost flow for the manufacturing company. We can see here there's 3 accounts: raw material, direct labor, and the manufacturer overhead. And if the company purchased raw material, we are going to debit raw material. If the company used direct labor, we will debit direct labor. If the company incurred manufacturing overhead, we will debit manufacturing overhead. These are expenses accounts. And then depends on how much raw material used. If they're used, we will credit these accounts. If the labor and overhead, we can calculate the application, what's the amount can be applied. So the applied amount we will credit, and their balance actually move to work in process. While we credit raw material, credit direct labor, credit our manufacturing overhead, we also debit work in process. So that's the cost flow. Yes, when there's more material used, so we're going to debit work in process. When there's more direct labor and overhead applied, we are going to debit work in process. And finally, some work in process become finished goods. We will credit work in process, and they will become finished goods. So for accounting, we will debit finished goods. When the finished goods sold, we will debit cost goods sold, and credit finished goods. So this shows the relation of different accounts, different layers of inventory, and their relationship.